The morning light filters through the tall windows of a library that has stood for centuries. Dust motes drift through golden beams, settling on leather-bound ledgers that chronicle numbers most people never think about. In this quiet sanctuary of knowledge, surrounded by the accumulated wisdom of generations, you can almost hear the whisper of pages turning, the scratch of quills on parchment, the gentle rustle of documents that shaped the world you inherited. The air carries the scent of old paper and polished wood, a testament to decisions made long before you drew your first breath. Here, in this silence, lies a truth so profound that most walk past it without ever knowing it exists. The numbers in these ledgers tell a story that defies logic, challenges everything you thought you knew about money, and reveals a pattern hidden in plain sight for over 300 years. Every country on Earth owes money. The United States carries 38 trillion in debt. Japan shoulders 9 trillion. China holds debts that dwarf entire continents. The entire planet owes $315 trillion, a sum 3 times larger than everything humanity produces in a year. But here's the paradox that should make you pause. If everyone owes money, who exactly holds the debt? When you trace the chain of creditors, when you follow the paper trail through institutions and intermediaries, you discover something that changes everything. The world doesn't owe money to anyone in particular. It owes money to itself. This isn't an accident. This isn't a mistake. This is a system that evolved over centuries, shaped by rational decisions made by rational people who never intended to create what they created. You're about to discover how 4 moments in history, spanning 3 centuries, built the foundation of every financial system on Earth today. These weren't conspiracies. They were solutions to immediate problems, each one logical in its time, each one creating consequences no one could foresee. The men who made these decisions were responding to the pressures of their era, using the knowledge available to them, trying to solve the challenges in front of them. They had no grand design. They had no master plan. They were simply human beings making human choices under human constraints. But those choices compounded across generations, creating structures that now shape every aspect of your economic reality. The first turning point came in 1694, in a London that smelled of coal smoke and horse-drawn carriages. The Thames flowed dark and sluggish past wooden wharves, where merchants argued over prices, their breath visible in the damp air. In the narrow streets, candlelight flickered behind leaded glass windows as the city settled into another cold night. King William III paced the stone floors of his palace, facing a problem that kept him awake. England was at war with France, and wars cost money. The royal treasury was empty. Tax revenue couldn't cover the mounting expenses of armies and ships and supplies. Traditional lenders, the wealthy merchants and nobles who had funded kings before, were refusing new loans because England had defaulted on its debts in the past. Into this crisis stepped William Paterson, a Scottish merchant whose previous ventures had failed, leaving him with little more than ambition and an idea that would reshape civilization. Paterson understood something that others missed. The problem wasn't that England couldn't pay its debts. The problem was that lenders expected to be repaid. What if, he wondered, the loan never had to be repaid? What if instead of temporary debt, there could be permanent debt? What if the government simply paid interest forever, and the debt itself became a new form of asset? His proposal was revolutionary in its simplicity. A group of wealthy merchants would lend the government £1.2 million, an enormous sum worth hundreds of millions in today's money. But instead of expecting repayment, they would receive annual interest payments of 8%, guaranteed by Parliament and backed by the government's power to tax its citizens. To manage this arrangement, Paterson proposed creating a new institution that would stand between the lenders and the government. He called it the Bank of England. What Paterson created was more than a bank. It was a machine that transformed debt into money. The merchants who provided their gold received banknotes in return, pieces of paper that represented their share of the permanent loan to the government. These notes could be traded, sold, used as currency. They were as good as gold, perhaps better because they paid interest. For the first time in history, a government's promise to pay interest became money itself. The more the government borrowed, the more money could be created. Debt wasn't a burden to be eliminated. It was the foundation of the monetary system. Parliament approved the scheme, and the Bank of England received its charter. The merchants provided their gold, the government received its funding, and the war with France continued. But something far more significant had happened. National debt had become permanent, not a problem to solve, but a feature of the system. The government would pay interest on that original loan for centuries, and that interest would flow from taxpayers to bondholders in an endless stream. Paterson had created the template that every government would eventually follow. Within 50 years, This model spread across Europe like a slow-moving tide. France created the Banque Generale. The Netherlands formalized its debt issuance. By 1790, the newly independent United States adopted the same system under Alexander Hamilton's guidance. Each nation discovered what Paterson had understood in that London counting house. Permanent debt, backed by the power to tax, could become the foundation of national finance. The debt structure wasn't imposed on governments. They walked into it willingly because it solved their immediate problems while creating obligations that would last for centuries. But Paterson's innovation was only the beginning. The system he created would evolve, guided by the decisions of three more men who faced their own crises, their own pressures, their own rational responses to the problems of their time. Each would add another layer to the structure, another mechanism that made the system more complex, more interconnected, more inescapable. What they didn't realize was that they were building something that would eventually encompass the entire world, creating dependencies and obligations that would bind nations together in ways they never intended. By the early 1800s, European governments had embraced debt as a normal part of governance. They borrowed for wars, for infrastructure, for the growing expenses of administering expanding empires, but the market for government debt remained primitive. Each loan required individual negotiation. Interest rates varied wildly based on perception and politics. Only the wealthiest merchants and banking houses could participate, limiting the pool of available capital and making governments dependent on a small group of financiers. This is where the story takes its second turn, in the counting houses and coffee shops of London's financial district, where a major cross-border financial network was about to revolutionize how governments borrowed money. This influential financial house began as a family-run operation in Frankfurt's commercial quarter, but by 1800, its 5 strategically placed branches had established operations in London, Paris, Frankfurt, Vienna, and Naples. This network gave them something unprecedented: the ability to move money across borders faster than anyone else, to gather information before it reached official channels, to see patterns that others missed. One senior figure within this network, operating from London, recognized that the real opportunity lay not in lending directly to governments, but in creating a market where government debt could be bought and sold like any other commodity. Instead of holding loans until maturity, he would buy government bonds at a discount and sell them to investors at a markup, creating a secondary market where debt became tradable, liquid, profitable. The innovation this financial network brought to London's markets wasn't just about moving money faster than competitors. It was about understanding something deeper about human nature, about how governments behave when they believe they have no choice. In the gaslit chambers where these financiers conducted business, surrounded by the rustle of silk and the scratch of steel pens on parchment, they created an early model of international debt trading, transforming government promises into assets that could be bought and sold like wheat or cotton. During the Napoleonic Wars, when Europe convulsed with conflict and uncertainty, this network positioned itself as the bridge between governments seeking funding and investors seeking returns. They would purchase government bonds at steep discounts, then sell them to pension funds, insurance companies, and individuals who wanted stable returns. The government received immediate funding for its needs. The intermediary collected the difference between purchase and sale, and investors received a piece of paper that promised steady interest payments backed by the government's power to tax its citizens. But here's where the pattern deepens in ways that still shape your world today. Before this network's innovations, when a government couldn't pay its debts, the consequences were relatively contained. A monarch might default, creditors would lose money, and the system would eventually reset. But the introduction of cross-border tradability created webs of ownership so complex that no one could fully untangle them. A British bond might be owned by a French investor, who sold it to a German bank, who used it as collateral for a loan to an Austrian merchant house. The interconnections multiplied until defaulting on debt wasn't just refusing to pay one creditor, it was threatening to destabilize an entire international financial network. This is the second mechanism that made the debt framework inescapable. Governments discovered they couldn't simply refuse to pay because their obligations had been woven into the financial fabric of multiple nations. Default would trigger cascading failures that could destabilize entire regions. What had started as a solution to immediate funding needs had evolved into a system where debt couldn't be eliminated without affecting the stability of the international financial structure itself. Governments became dependent not by force, but by the mathematics of interconnection. This multinational financial model spread across Europe like spilled ink on parchment, seeping into every corner of international finance. By the mid-1800s, sovereign debt had become the foundation of international capital markets. Large financial firms operating within this model accumulated significant wealth, and that wealth came from a single source: the interest payments that flowed endlessly from taxpayers to bondholders. They had created a self-reinforcing structure of borrowing and lending sustained by government promises and investor confidence, and every nation that needed capital had to participate. But the system they built was still constrained by physical limits. Banks could only lend the gold and silver they actually possessed. Money supply was tied to precious metals, creating natural boundaries on how much debt could be created. Governments could borrow, but there were limits to how much the market could absorb. These constraints would hold for another century, until a third turning point fundamentally changed the rules of the game. The cobblestone streets of New York's financial district echoed with the clip of horses' hooves and the rumble of iron-wheeled carriages as the 20th century dawned in the narrow canyon between tall buildings where shadows lingered even at midday. Men in dark suits and bowler hats moved with purpose through air thick with coal smoke and ambition. The United States had become an economic powerhouse, but its financial system remained primitive compared to the sophisticated networks that had evolved in Europe. Banks operated independently, competing and sometimes failing spectacularly. There was no central mechanism to manage the money supply, no institution that could respond quickly to financial panics. The dust settles back onto those ancient ledgers where this story began. And you understand now what those numbers really mean. 315 trillion isn't a debt that will be repaid. It's the foundation upon which the modern world operates, as essential and invisible as the air you breathe. The system never set out to trap anyone, but it never learned how to let anyone go. If this changed how you see the patterns that shape everything, then you're beginning to understand the quiet mathematics of civilization itself.